Blain, a discussion about your money, including everything from investing and taxes to real estate. Now, with this week's program from D.L. Blain Company in New Bern, here's David Blain.
Hello, I'm David Blain, and welcome to All Things Money. For the next 30 minutes, we'll take an educational, stimulating, and hopefully entertaining look at your money. We'll give you some information and actionable ideas that will help you keep more of what you earn, create or maintain financial independence. Remember, the show is about you and your money, so if you have any questions or comments, feel free to give us a call at 633-0107 during normal business hours, or email us at any time at allthingsmoney@dlblain.com. That's allthingsmoney@dlblain.com. We'll try to answer your question or address your topic on a future show. But if you email us or call us with a question, we'll be happy to send you a free copy of our quarterly newsletter, Financial Focus, which we have a lot of really good information in. Today we're going to start with a little bit of an update on the stock market, and we'll move into finish up a little bit on currencies, which I didn't have a chance to last week. And finally, we'll finish up with questions from our viewers and listeners. So first, let's talk about the stock market itself. I know that the stock market has been causing a lot of anxiety for people the past 30 days or so. And in fact, the S&P 500, which tracks the 500 largest companies in the United States, that's the S&P 500, made its high back in April the 23rd of this year. Since then, I just looked this morning before starting the show. Since then, it's down about 10.69% from its peak April 23rd of this year. And that, of course, is up over the low of the market was in March of 2009, and then we've come full circle, and now we've had a 10.69% correction. When I use the term correction, I'm talking about any decline from a peak down at least 10%. I consider a correction. The Russell 2000 Small Cap Index, which tracks the 2,000 smallest, well, they're not the smallest, but 2,000 of the smaller companies in the United States, is off about 11.62%. Once again, it reached its peak April the 23rd as well. As we move overseas into Europe, some interesting things occur. First of all, the European Monetary Union Index that I track made its peak January the 11th of 2010. And so you see that the European market started in decline way back in January, and the Euro Index is off 24.51%. So a more than 2 times decline in Europe. For people that are heavily invested in Europe, not a good thing, but for people looking for bargains in the future, it may present some interesting opportunities. What has been up this year, so far this year, the dollar index, and we'll talk more about currencies later, has been up. Gold has continued to move upward, as well as your higher quality bonds, your high yield bonds, and some of those type of more credit risk type bonds. They move a little bit more in tandem with the stock market, but your normal, your treasuries and things like that have done okay this year. So the big question that we're getting is, so is this going to be a repeat of 2008? Are we in store for much of the same that we saw in 2008? And I guess the short answer is no, I don't think so. As we say many times on this show, I don't profess to have a crystal ball and don't really like to make predictions. What I try to do is study history and determine if this current environment is similar to another period in history or if it's different. And so that's what we're going to do here. We'll look at the difference between 2008 when the market started collapsing in September, October 2008, and today. So first of all, back in 2008, the stocks had been in a cyclical bear market since about 2007. So they'd already been declining for many, many months in 2008 when we had the collapse. Obviously today, this correction that's happening today is taking place within the confines of a cyclical bull market. Since March the 9th of 2009, the markets are largely up. Even after this correction, the majority of countries around the world are still in uptrends. Of course, the notable exception being Greece and Spain. But the majority of the markets are still in uptrends even after this correction. The second thing is the market breadth in 2008 was decisively negative. And market breadth is an interesting concept, but basically it looks at things like volume as well as the number of stocks. I mentioned earlier the Standard & Poor's 500 index, and it measures the 500 largest companies in the U.S. Well, the largest company, which is ExxonMobil, gets more of a weighting in the index, and so the S&P 500 could go up or down in a given day, and depending on how Exxon does, a small or a large percentage of that decline or advance could be due to ExxonMobil. Example I use is, let's say that you read in the paper that the Standard & Poor's 500 went down 0.5% today. Well, when you look at the details, maybe every other company was unchanged and only Exxon went down 0.5% that day. And maybe only 100 shares were traded that day. Everybody else was on vacation. And so you have only one company going down, and you have very, very light volume. That day, when we talk about breadth, that would be very weak breadth, meaning that very few companies went down, and there was very little volume. In contrast, if you have a day where just about every company declines and the volume is tremendous, that is very, very bad breadth. Good breadth would be where the majority of companies advance and there's a lot of volume. And so you have to look at more than whether the market is going up or down. You have to look at the number of companies that are going down as well as the actual volume, the number of people that are buying and selling on that day. Okay, so market breadth, if you have a lot of participants and most of the companies are going in one direction or the other, then that has a little bit more information for the investor. So anyway, back in 2008, the market breadth was very negative, meaning that the majority of companies were going down on lots of volume. In 2009 or 2010, currently in this decline, the market breadth is still somewhat neutral to positive. We're not seeing the broad-based declines in every market on tremendously high volume. Well, that takes us to our first break. When we'll come back, we'll continue this discussion about what's going on in the equity markets. For All Things Money, this is David Blain.